it's Kathy Fettke, and I'm here in Miami, actually Miami Beach, Florida, at Fund Launch Live 23. And there's all these people here who are starting funds and all kinds of different things. And so I thought I'd go around and find out what people think about commercial real estate. Do they think that the headlines are scarier than reality? So let's go take a look.
I think that there are a lot of operators that got into the business in the last year, 2 years, 3 years, bought very aggressively. And I think we're starting to kind of see the fallout from that, especially in the multifamily world. But the thing about real estate is it goes in cycles. This is not new. We've had cycles before. When you're buying real estate, you just have to be ready to adjust to the point in the market cycle that we're at, right? So the strategy is going to change.
The last couple of years, what I've been saying is that, say, the last 5 years, you could have been a bad operator, got into a bad deal, and the market would have still made you look like a rock star. Now we're going to start seeing who are actually good operators, who actually got good deals, because the market's not going to save them. So I don't think there's going to be a crash, but I do think that there is going to be a lot of expensive lessons learned from people. But with that, not that I'm looking for anybody's downfall or anything, with that, that's going to mean that there's going to be a lot of opportunity for everybody as well.
I think it depends, right? It depends what markets you're buying in. It depends what asset you're buying in. People always ask, like, how is the real estate market? And the real estate market is hyper local, right? It depends if you're in Florida, if you're in California. I think things like migration patterns are huge. You know, you and I live in LA area, which we've seen a net loss of about 2% the last couple of years. Florida's picked up like 2%. So I think it depends what the asset is. I think, you know, one risk or one concern we have is there's so many billions, or I don't know if it's trillions, of multifamily debt that has to be rolled over, commercial debt that has to be rolled over within the next 12 to 18 months. So the question is, well, what is that going to look like? If people have to roll over a lot of these, we do value add multifamily, you know, if people are not great operators, they can be in big trouble when it's time to roll that debt over. And so we are seeing some situations that are distressed, some things are out of people's control, some is they just didn't really plan out very well, or they're new operators. So we think there will be some opportunity, but there's so much cash on the sidelines. Bloomberg had an article a few months ago saying there was $5 trillion in cash in it, just from Americans on the sidelines, which was like the highest that we've ever had, which was in 2020. So I just think there's going to be, especially when rates start to level off or maybe slightly tick down in the next 6 to 12 months, possibly, there could be a lot of money that floods back in because lenders will want to lend again. And so I don't know, I'm seeing some distress, but I don't think it's going to be nearly as bad as what people say.
Yeah, so one of the big ones is not having rate caps. And so rates are adjusting, and you know, I've had a client that calls and says, yeah, you know, my mortgage went up by $100,000 a month now. And that was all the money that should have or could have been going as distributions, but now it's just servicing the property. Another thing that I've seen that I found, I'm just gonna say interesting, is some lenders are also looking for ways to get out of the deals that they made 2 or 3 years ago when interest rates were, you know, 3 or 4%. If they're saying, now I could lend that money at 9%, how can I get out of this deal? And so I've had clients that they're paying their mortgage on time and doing everything right and managing the property well, but maybe they switch property managers. And in their loan documents, it says, if you're gonna switch property managers, you gotta tell us. Now they switch to a property manager that's an arm's length deal, a reputable company, it's not in-house or anything like that, but the bank says, hey, you switch property managers and that means you're in violation, so you're either going to have to retrade with us and we're going to give you a higher rate, or we're going to call this loan. And so seeing things like that is definitely not great to see, but that's something that I've seen as well that I thought was a little odd.
So, I mean, it's been very scary for people to see big banks fail, right? And what's been going on. So what I've noticed is that people definitely take their assets and they're moving them to different places. So rather than keeping everything in the bank, which seems okay for a while until we see these things happen, they're making sure that they're invested in many different asset classes, including the stock market, but then also into alternative investments like real estate. And we also added on the ability to do self-directed IRAs because people want to take their retirement accounts and put that into alternative investments as well, with keeping the tax advantages.
What are some of the best tax advantages you're seeing?
So when it comes to retirement accounts, right, if you use the tax, you can do 2 ways. If you have a Roth account, that's tax-free money at retirement. So your investments are going to grow tax-free. And then if you're using tax-deferred accounts, that's just deferring the taxes all the way down the road. So that's why when it comes to alternative investments, using the self-directed IRA for that. Outside of that, there's different portfolios, stock portfolios, where there's just tax-qualified dividends that come in, especially through municipal bond funds.
I think the U.S. economy is too strong to collapse. Any of these asset classes are too strong to collapse. Now, you might see some decline in some of the asset class within commercial real estate, but I think MB Capital, we are in multifamily, and we know even if there's a recession, if there's a mild recession, multifamily is always going to be recession-proof. So there are some asset classes like offices that we are seeing some decline. We've seen the news as well in terms of percentage decline of the occupancy and the way it goes on. But the U.S. economy is still too strong to collapse, and I don't think the commercial real estate as a whole is still going to be a good asset class to invest compared to stocks and any other long-term holds that you might look into.
I'm always optimistic because look, there's money to be made in every market. Everyone thinks that in the bull run we made money in real estate, which we did, but the bear run is where real money is made. This is where more millionaires will be born in this part of the market cycle than there were in the last part.
Well, media will always have some frenzy. They will have the narrative that they want to tell, and there's so much fear that can induce in a regular investor's mind. But as a passive investor, you have to think about where to look for and what to look for. In any environment, you're going to make money, but you just have to find that right investment type and the deal that you need to go in. For example, industrial real estate has been a hot topic. It is not just this year, but next 10 years, industrial is going to do great. With all the reshoring that's happening, manufacturing coming back to US, industrial and manufacturing industry is going to give you great returns. So it's not about if commercial real estate is in trouble or not. It's just that you need to find where to look for and which asset class is going to provide you a better return.
Right now, we've actually shifted a bit from real estate. Primarily, we have $200 million in multifamily, mostly in Jacksonville, Florida. We're doing ATM machines and car washes and oil and gas and things that don't have any leverage. They've produced consistent cash flow, really, whether there's a recession or no matter what things are happening. And then some things that maybe have a little more speculation, a little more higher upside if they go really well. So we're looking at just because of, we find to raise money for a multifamily or a commercial deal, it's about 4 or 5 times as hard. You've got to raise twice as much money because the loan to value is much different. Instead of 20% down, more like 30, 40% or higher down. And then investors are half as likely to give it to you. So it makes it way harder versus things that are more alternative, especially things that are really consistent cash flow. So I love ATMs and car washes and things like that for cash flow.
What I really love is deals that are underwriting the best are the ones with loan assumptions on them, because now we can assume loans that were underwritten 2, 3, 4 years ago with these low interest rates. Now we're getting the ability to take that over in 2023, and the blended cost of capital is phenomenal and it's generating really great returns for investors.